I want to bring in our analyst joining, Ygal Arounian is equity research analyst at Wedbush Securities. Ygal, great to have you on the show. So with much of the street, a big surprise here. You guys dropped your target to $30 from 90, from a buy to a neutral. The street was pretty bullish on this company. Tell me how everyone got surprised on this.
Hey, thanks for having me, guys. So, look, essentially what happened was I think most people, including ourselves, kind of underestimated the impact of the amount of capital or the impact that the amount of capital in the space would have on Grubhub and its ability to maintain its leadership position and strength. So, look, this is still a massive space. The restaurant takeout market in the U.S. is a $250 billion market. Grubhub was a leader. Saw competition come in, try to disrupt them, and you saw that play out over a period of time. But Grubhub maintained strength within its diner base. Wasn't seeing deterioration of kind of the core KPIs that it wants to see from its diners, and that essentially broke down beginning in August, and it really changed. It was a big paradigm shift for Grubhub and its business, I think.
So how do we then view this? Do we view this as a wake-up call for Grub to do something, or is the point that as a real first mover in the space that there's not much more they can do but try and either get scale or what? I mean, what's the next move here after this company that was, again, really the kind of the entryway to food delivery? If they can't make it, what does it tell us about the business model?
Well, scale's certainly not an issue. Grubhub has scale. The other kind of big scaled out players are DoorDash, Uber Eats, and Postmates in the U.S. And those are the big four that have scale. The issue is that there's just too much competition, and you're right in that there's not a meaningful amount of proprietary models in the space, and everyone's offering delivery and access to restaurants. And what you've seen is the excessive capital in the space lead to companies essentially discounting and offering orders at rates that likely aren't sustainable over a long period of time. That's what happened. That's what Grubhub is reacting to. They are reacting to that now, and they are going to be offering things like free delivery, and they are trying to adjust. But this is something that's going to likely play out over a long period of time, and the economics won't really improve until we see some consolidation or you start to see some better rationalization in the industry, and it really looks like we're not there right now.
So walk me through how you try and assess, because we've got analysts or investors, traders watching that have been riding this company on an epic run upwards, right? And then this incredible crash down from the highs. If they don't have a moat around the business model, but yet we see from the evidence, there's still clearly an uptick in sales. There's an uptick in the number of people who are ordering overall. As you described, the overall market for food delivery is huge. I don't think anybody needs to sell the concept of why people want the service. But from an investment standpoint of trying to figure out what the stock is worth or what the earnings or cash flow are going to look like for this company, is it possible, to have such a reversal in the shares, in the average price targets? How do we feel confident about figuring just what this company is worth?
Well, that's what's gotten a lot more challenging after the report yesterday. Essentially what happened was Grubhub came out with let's call it a preliminary EBITDA target of what they called at least $100 million in 2020. That was about 70% below where consensus estimates were.
Wow.
And so that's why you have this big sell-off and the big change in sentiment. It's a really big impact. You start to see exactly what happened, and to us the biggest factor that really changed is that Grubhub started to see diners not being as loyal. So they'll use Grubhub as well as other apps like Uber and DoorDash, and they were seeing that the newer diners that they were adding were not ordering as frequently as they used to. So you had less frequency, less loyalty, and that's leading to likely lower lifetime value of customers, and that's again, it's a really big paradigm shift for the company. What that likely means is that we're going to be in an extended period of market share battles, and so I don't think there's a lot of confidence in that $100 million target next year necessarily, and you could see even more investments in discounting in an effort to take market share before things start to ultimately turn around.
Yeah, I'm glad you bring this up, Ygal, because the sales and marketing expenses almost doubled from a year ago, I think, speaking to the need for Grub to compete with the new entrants. Uber Eats, of course, as well. I want to get to that in a sec, but if this is going to have to keep ramping up, then does that mean they're going to eat into their margin even more? Does that mean we should expect a decreasing profitability?
Well, we are seeing a decrease in profitability. Grubhub's original model was a brilliant one. They were just a marketplace business. They were in big urban markets where people ordered often, and they were able to get the restaurants to deliver themselves. So they had a really high margin structure in that business, and they loved being there. Then what happened was you had Uber come in and DoorDash come in, and they started to deliver for restaurants, and the structure in that business is a lot less profitable. But Grubhub had no choice but to follow suit. So, what you're essentially seeing is a business that used to have over 30% EBITDA margins, next year ranging towards mid-single digits, and that's that's a gigantic factor in why shares are down as much as they are over the past year. You have an erosion in that margin structure, and a lot of that is coming from the competition and the discounting. And I think investors would be concerned that that margin continues to deteriorate and could potentially be negative before it starts to improve.
Ygal, my question then is, if we're seeing one of the big red flags that we talked about here on the show seemed to be when Amazon experimented with the restaurant and delivery business and then basically said, it's not for us. If Jeff Bezos can't find a market there, it seemed like maybe something like a judgment day was coming. My question on Uber Eats, because you and I have talked to Uber before, and I know that many view the Uber Eats as a positive for the stock relative to Lyft. Should we question that as well now, or do we really have insight to say Uber is a competitive force that's taking that market share? Does the Grubhub move now make us revisit the valuation for Uber and Uber Eats?
Absolutely. And we've kind of changed our tune a little bit on Grubhub, Uber versus Lyft. Over time, as it's become clear that at least in the short term, Lyft's kind of focus on rideshare only in the domestic market only is a better, safer place to be in, with a market that's maturing better and is seeing stronger competitive dynamics and more rationalization. I think Grubhub's news yesterday that they're going to step into discounting, offering free delivery. I think that's only going to accelerate things in terms of the battle for market share in the U.S. Look, I mean, Uber was as well, but DoorDash is still private and backed by SoftBank, and we haven't seen any hesitation by SoftBank to invest capital into its companies. And there's an argument that the kind of WeWork debacle and the public market reception to unprofitable companies would lead to rationalization. That was an argument that we've made as well. But I think at this point you could kind of take the opposite point of view, where to sit here and think that SoftBank is going to let DoorDash go public this year or early next year and take another hit on an investment, rather than fund them again and kind of double down and let them battle before they kind of mature and maybe come out in a better position. I think that's more of a likely scenario at this point, and I think the SoftBank has incentive to protect DoorDash in a private market for a little bit longer. So I think we're going to have strong competitive dynamics in this market for a while, and I think it's a negative for Uber.
Okay. Ygal, really good to have you here this morning. Appreciate you joining us. Thank you.
My pleasure.
You got it. Ygal Arounian, equity research analyst at Wedbush Securities.